Manish, the other point is, this domestic liquidity has created bubbles in some areas, yes, for sure. I saw your tweet as well. Everybody's talking about the huge run-up in the recent IPOs. Are you getting a sense that some pocket does?
So it will happen when there is liquidity. But look, when you say a climax of a market, you get tremendous amount of money flowing into one or two sectors, or 5 or 6 stocks only lead the market and it climaxes. And there is gigantic flow of money there. I think the stocks that you're mentioning are, end of the day, there were 1,000 crores, 2,000 crores of capital coming in. It's not if I take a 2008 example, that $80 billion book was built in the IPO, which then popped the whole market. I don't think we are there yet. And it is a sign of exuberance in the market, and it would be in a bull market when people are making money. Last 2 years have been good for people in the market. Not unusual, but it's not suggestive of a climax. It's suggestive of
a bit of a caution.
Pockets of them having irrationality.
What on the entire banking BFSI space, Manish? Lots been happening. We saw a big mega merger announced very recently. What's the general view in that space? Are there good value left, or
think of it. Any industry cycle, you go through 4 phases. The first phase is when you get unit volume growth, and the people who are able to grow unit volume growth don't discuss anything beyond that. And think of, say, an HDFC bank is still able to generate unit volume growth. They're going deeper into the markets and so on. The next layer is when you do pricing. And if you think back to the old days, this was, say, the Nestle's and the levers used to do price increases because they were not getting volume growth. Then phase 3 is you start tightening your efficiency and working capital and cost saving. And item 4 is when you are in restructuring mode. When you are in restructuring mode, it tells you that I have run through my big 3 levers. And while the sector looks like it's in its infancy, there are some people who need to do restructuring. So they are at probably the wrong end of their own cycle or their business model. And maybe they have a path forward to what they wish to achieve. And it's not a commentary on which company is merging with whom and so on, but it's suggestive of what the management intention is and where they're heading with that. And you could do an acquisition like, say, Kotak did an ING, which was biting something to extend into a particular area. And that would make strategic sense. So there are different ways to skin the cat.
In terms of themes, Manish, I know you're a bottom-up, you look at stocks, but you also look at the top-down macro picture very closely. From that perspective, any big theme which looks like emerging out of India in the next?
Honestly, if you cut India, you used to always do consumption themes. Then you do export themes, then you do financials, then you do commodities, energy, stuff like that. So if you think of the big pockets of money, that's where they are sitting. Currently, the export theme, because we've been so generic, sort of either the pharmaceutical generic or the IT sort of generic worker, both have been under some crowd. And the rupee looks like strengthening rather than depreciating. So it's not a sweet spot for them to be making money today. There's renewal to happen there, and there's a lot of disruption in both the spaces. Surely there will be big winners and big losers in that, and it's not something that you can ignore. These are good managements, and they have proven themselves against best in the world. So that's a space to keep an eye on, but it's not currently going to be some big money maker. When you look at the consumption basket, there are the staples, and then there are the discretionary, which is more cyclical in nature. By and large, the staples, I don't think you can justify valuation given the volume growth possibilities over there. So it's a place to hide out. But in the discretionary space, and largely people have been in auto or media or stuff like that, there is clearly money to be made there. You take area 3, which is financials. Financials itself has broad-based so much that while some of the NBFCs look really scary in terms of how the market's valuing them, and given what is happening now with GST and demonetization and what happens to the informal economy to whom a lot of these people lend, I think there could be an air pocket there, whereas the market's been only focusing on the corporate NPAs. There may be some worries coming over there, but there would be contra trends and therefore opportunities to make money in that. So lending is one basket, but then as you see, there's insurance companies coming, there are asset management companies coming into the market, and so on. So there are opportunities to do that. Similarly, you got in the last year 2 banks getting listed, which have created wealth for shareholders. So there's always opportunity. And the last, of course, is commodities, where while of course in energy, I have certain views on what happens to oil and coal in the long run. But I mean, if you can milk that profit, deploy it into something sensible, there is still opportunity there because valuations are in your favor. In metal, again, I think we are in a sweet spot in particularly, well, the ferrous side, some people love because this MIP has come and it's a 4-year ban, but the non-ferrous looks also very, very interesting with what's happening in aluminium and stuff like that. So there's enough to do actually.
Correct. No, we spoke about global liquidity and US and to some extent Europe as well. But what about China? Can that be a bit of a disruptor?
So China is the black box in the world. And I mean, macro for all the large economies is really terrible. So while we focus on US because you get a lot of, print or publication from the US, correct. Europe is opaque, Japan is even more opaque, and China is the most opaque. So you tend not to see information coming from there. But all these 4 large economies of the world are in macro bad shape, and we are the converse where we are in macro good shape. So which one of these becomes the sort of one which surprises the world? I can't honestly hazard a guess because the market would have priced if I knew it as well. But it is something to keep an eye on. So macro dislocations and technology, these are the 2 sort of big risks in the market. And the underlying reason to own stocks is really, I still think the potential for my business and the management running that business is still great. And they are good enough to manage these dislocations when they come. And that tripod is really the way you have to be managing and looking. And if your portfolio is built with a proper asset allocation and there is enough risk metric in your portfolio that you're not gone crazy and you have such a large position that one event can hurt your entire holding, or it's such an overweight that you get nervous and you sell the rest of your holdings to defend one. And your equity holding for the average investor is not disproportionate to the rest of the portfolio, I think we are still in a good place to be. There's still money opportunities.
So right now, how would you rate your various asset class, equity, gold, and...
Well, I'm 100% equity guy. So you're asking, you go to a barber and ask, do you need a haircut? So,
no, for a layman investor...
For a layman, look, India is by definition underinvested in equity. So, if you have, like I said, 3% of your saving is coming to equities and we're getting worried. It's a long way for us to really blow ourselves up with investing in equities today. It's a long, long way off. And like I said, there are always so many businesses coming that even if 2008, when the world was blowing up, if you had bought Sun Pharma or TCS, it's still 10x from that. So just because the world blows up doesn't mean your company doesn't make money. But you don't think that the market owes money to you just because I decided today I should have an equity portfolio. You show up and you buy stocks. It doesn't owe you any money. If you have a circle of competence, you have the temperament and the ability to hold when the chips are down, there is money to be made.
Manish, Nifty at 10,000, if we roughly assume a 15% CAGR for next 5 years, the Nifty doubles. It will be 20,000. Is this the right assumption to make? Will that be the...
So earnings haven't gone anywhere for 4 years.
For last 4 years, correct.
So the tendency of businesses is when it comes back from a cyclical downturn, the cyclical upturn earning compounds much faster than that. If you take a stat, we used to be a 7.5% of GDP as the profit in the peak of the mid-2000s. We are at, I think, sub 4%. So actually earnings itself could be double of where we are today. And then at that time it doesn't look like a 15% commodity. You could do a 40, 50, 60% and that will come in the cyclical stocks. So if you think back in the last cycle, what was happening to earnings of say Vedanta or Larsen & Toubro and companies like that, they just took off.
No, in fact, metals have performed well in the last 1 year.
And similarly, like why is people making so many bets on auto that auto sales have been in like flat for 4-5 years at 2.7, 2.8 million cars. Let's say you go to 5 million cars. China is 26 million cars.
Exactly. I saw
so if you get that kind of upcycle, then what happens to you? So that's really the hope. The equity investor at heart is an optimist. So while I look out for all the factors to be paranoid about, at heart I have to be an optimistic guy looking to brighter days ahead.
Last question, Manish, before we wrap. What could be the downside risk for the Indian markets, at least in the short term?
So like I said, it depends on the event, right? Because when you will ask anyone, you'll say, oh, 10% correction should be there. And at 10% lower, we'll buy the market. Why will we buy the market? Because we think terminal value of India is very large. So even when events occur, what happens is the smart guys come back to say this is the time to shop because there is blood on the streets. And we know terminal value of India has not gone up. It's actually because of the way the macro has now been handled, the political leadership which has come into place, the younger people who are now coming with better corporate governance running companies, and this whole unorganized to organized shift is making this structurally one of the most darling markets of the world. So whenever there is a big collapse in the world, your first thought should be what stocks do I want to buy. So you keep that researches ready. I don't know which stock falls on the day the market crashes, if it crashes, but on that day I should be ready with my pencil sharpened. And that's the way to think about it. So, plan for the worst, hope for the best. That's really all you can do.
Thank you very much for talking to me today.